Hold on.
Oh,
I'm
too,
on.
too late.
Okay. All right.
Hey,
That's
when we go live, everyone, you get what you pay for.
every
And
single time I go live, my dogs start barking. It's the weirdest damn thing. Hey, knock
that's
it off, would you please? Thank you. Okay.
oops.
All right. That's
And
all it took.
and then I'm screwing up over here. There we go. Hey, Andy Schectman, thank you. Thank you for joining me again this week. People will realize that we're just a couple of normal dudes
Yeah.
who who work out of our homes, or we our studios are in our homes, and we have dogs. And
Yes.
if you are a cat person, God bless America, that's fine. But you probably have a quieter home than we do. But we're both dog people.
Well,
So
I think my dogs like speak amongst themselves and they say, all right, we're ready to go live. Get ready.
yeah. So yes, the dog conspiracy, how to screw up the Todd and Andy show. Everybody, we're back. We're back with Andy Schectman, and I believe that we missed last week. So lots has happened since then. And I think, sorry to spin it this way, thank you, World War III, but business has been good for those in the gold business. Yes?
Yeah, there's been an awakening, no question. I think people understand that things are, even if they can't really articulate, Todd, what it is that's bothering them. I think there are so many things happening in an accelerated fashion that it's concerning people enough to explore alternatives. And when you look at what's going on with the volatility in the treasury market,
Mm-hmm.
normally people, when in times of chaos, would move to the treasury market. And even though we've seen I guess you could call it a short squeeze, a rally in the treasury market in the longer end of the bond market, which I guess you could predict when you had such a massive short position in the US treasury market, always seems to work that way, and when you think you are smarter than the market seems to slap you upside the head. I don't think this is a reversal in trend whatsoever,
Right.
but one of the things that it is um, a snapshot of the fact that over the last 45 years, the treasury market has always been less volatile, downside risk or downside volatility, than the gold market. That changed, and that changed here recently. And for the first time in 45 years, we're seeing greater volatility in the
Mm-hmm.
treasury market. And from a historical perspective, if you go back hundreds of years, the concept of owning government debt as an asset is a relatively new phenomenon. And I think what you're seeing is a
Mm-hmm.
regression to the mean, where there's an awakening amongst big players, China, Japan, Saudi Arabia, many other countries around the world that are shedding U.S. treasuries in favor of gold. And I think they look at gold as the preeminent form of savings. Again, where you see for the first time in 14 years, well, let me rephrase that. China's treasury holdings are the lowest they've been in 14 years. Saudi Arabia is the lowest they've been in 6 years. And yet, if you look at the gold acquisition, the amount of ounces that the countries are buying, it's off the charts, and China is no exception. In fact,
Mm-hmm.
they're loading up on gold right now at a level that we haven't seen in a very long time, whether it be China, whether it be Russia. Russia right now, with their acquisitions this year, puts their gold holdings at the largest holdings in Russian modern history ever,
Wow.
over 2,360 tons, and they probably have a whole hell of a lot more in that. And the PBOC, the People's Bank of China, in the third quarter added 179 tons. It brings their year-to-date purchases to 593 tons, which is 80% more than it bought in the first three quarters of last year. And when you put that into context, that they've bought for 11 straight months, that they're buying way more than they did last year, which was, you're talking record years for central bank holdings. And at the same time, their treasuries are at a 14-year low. So what you are seeing is not only public awakening, but I think an acceleration by the big money, especially those that you could argue have a vested interest in perhaps not being completely ideologically aligned with the West, and they're selling
Right.
treasuries and buying gold. And that is one of the things that is, I think, buoying, if you will, adding stability or a floor underneath the metals market. Um, Great volatility in treasuries, big money selling gold or buying gold and selling treasuries. These
Yep.
are are headwinds for gold that I don't see changing anytime soon.
Hey, Mike, I prepared a question for you.
You did it again.
And
You did it again. I know that you. I know that you are. You do this with Mike all the time. But I was gonna see if I was gonna catch you. See if I could catch you. Yes, I know it's hard to do.
no, and for those watching, you want to hang in today because we're going to have some fun too. I'm just determined to have some fun in these World War III times. And we're going to get kind of creative. We're going to go down a creative path today, Mike. But first, I was thinking about the government, and I articulated this question. I wrote it down. Mike, can a government push fiscal deficits to all-time highs, run up monstrous debt, blow up the largest liquidity bubble in the history of the world, and then jack jack interest rates higher at world record speed and expect nothing to break?
No, of course not. And that's exactly what they did. This is what you just explained, in essence, is the plight of the banking industry.
Yeah.
Where the banks, when interest rates were so low for so long, they were incentivized, I guess you could say, to buy treasuries because, look, there were very few places that you could safely put your money. And so they weren't incentivized to buy treasuries, shall I say, but they weren't concerned about buying treasuries and mortgage-backed securities to offset the liabilities that are their deposits. In other words, when you deposit money into a bank, it is an asset of the depositor, a liability of the bank. And when you talk about adding more money to the system that had been created in the entire history of the country over the last 4 years, or another way of saying that 80% of all the dollars that are in the system were created in the last few years. And that's massive amount of money that supposedly would have entered the banking system. Well, when it got into the banking system, it had to be offset with assets. And those
Yes.
assets were 10-year treasuries predominantly and mortgage-backed securities. And so they had no reason to believe this low interest rate environment that we've seen for over a decade, where not only were we throwing money at the economy, but we were suppressing interest rates, which not only creates lots of distortions in asset prices, Todd, but
Yep.
it also incentivizes companies and institutions and individuals to take on added risk in the assumption that rates stay low for a long, long time or for the foreseeable future. In other words, well, maybe we could add another wing to our warehouse, and maybe we could hire 27 new people and roll out that division that we always wanted to. And you know what? Maybe we can afford that new Lexus that instead of the Toyota. And you know what? Maybe we can actually buy a little bit of a bigger house with a bigger mortgage because rates are so low. And maybe we can go into more and more and more and more debt because rates are so low, and they would never jack it up on us that fast. And then bang, not, my point is they didn't raise rates high enough. I think they should still be a whole hell of a lot higher to combat inflation, but they raised them faster than they ever have. And the
I see.
speed at which they raised them, I mean, you could argue it's still a lot when you go from roughly 2% on a 10-year treasury to roughly 5%. That's evisceration at a level that the bond market has never seen. This will go down as the worst bond market crash ever. But what it really, really did was it created all of these distortions in asset prices. The low interest rates and the easy money created anomalies and distortions and misallocations in capital and resources where homes doubled in a year. Your home in Florida, it doubled in a year, but did it? Did it really? I mean, if rates keep going up, did it really double? And your stocks went way, way higher. Did they? Or when rates rise to find equilibrium with asset prices, did they really double?
Well, let's stop here. Let's educate people. That may go over some people's heads, right? Let's do a use case. If you have a home that's $500,000 and in a year or 2 or 3 years, it's $1 million, you say, is it? So unpack that for us. Why wouldn't it be? I mean, the realtor told me it's doubled. I'm like clapping my hands saying, oh, now's the time to buy. I have $500,000 in equity that can be taxed if I don't roll it.
Okay, just lost you, buddy. I think you're glitching a little bit. Are you still there? Uh-oh. Todd? I lost you, my man. Bummer. Todd, you there, buddy? All right, well, we'll try to reset this.